Hello everyone. Today, we'll look at how firms measure their performance using total revenue, total cost, and profit. Understanding these three concepts helps us analyze how businesses make production decisions and determine whether they're earning enough to stay in business. Let's start with total revenue, or TR. It's simply the amount a firm earns from selling its product, price times quantity. For example, if a company sells 100 shirts for $20 each, total revenue equals $2,000. Easy enough, right? Next, we have total cost, or TC. This includes all the costs of producing those goods, materials, labor, rent, and other expenses. But economists define total cost a bit differently from accountants. We include both explicit and implicit costs. Explicit costs are the direct out-of-pocket payments, like wages or utility bills. Implicit costs are the opportunity costs of using your own resources. For example, if you use your savings to start a business, you give up the interest you could have earned elsewhere. That's an implicit cost. Here's your first question. Why is it important for a firm to include implicit costs when calculating total cost? One special kind of implicit cost is the opportunity cost of capital, the return you could have earned if you had invested your funds elsewhere. So if your business earns 8% on its investment, but you could have earned 10% in the stock market, your opportunity cost of capital is 10%. Economists use these costs to calculate two measures of profit: accounting profit and economic profit. Accounting profit equals total revenue minus explicit costs. It's the number you'd see on a company's financial statement. Economic profit, however, subtracts both explicit and implicit costs, including the opportunity cost of capital. If economic profit is zero, the firm is earning a normal profit, just enough to cover all costs, including opportunity costs. That means the business is doing as well as it could elsewhere, no incentive to leave the industry, but no excess return either. Here's question 2. If a firm's accounting profit is positive, but its economic profit is negative, what does that tell us? So remember, total revenue measures what a firm earns, total cost includes all resources used, and profit, especially economic profit, shows whether those resources are used efficiently.